Hey, it's Lon Welsh, and you may have noticed in the headlines recently that this term ARM, adjustable rate mortgage, is back in the news. So there haven't been a lot of ARM mortgages over the last 5 or 7 years because the fixed rate mortgage, which is the other alternative, has been so attractive as a low interest rate, there was no reason to look at getting an ARM. So if you're a buyer, if you're not familiar with this, you have a choice of either locking in the rate for 30 years, it's called a fixed rate mortgage, or you can have a rate that'll be locked for 3 years or 5 years, and then the rate will adjust every year based on some sort of an index for the rest of the life of your loan. That's called an ARM, or an adjustable rate mortgage. So this first chart I want to take a look at here shows you the typical rate for a 5-1 ARM. When you see 5-1, what that means is it's going to be locked on the rate. You're going to figure that out before you close on your home. Locked for the first 5 years, and it'll adjust every 1 year for the last 25 years. So we're going to compare how are those 5-1 ARM rates compared to the fixed 30-year rate. And you can see from January of 2021 through about December of 21, they're almost effectively the same rate. Sometimes even, surprisingly, the ARM was slightly more expensive. No one would take the risk of having an adjustable rate mortgage when you could lock in the rate and have it be cheaper. So there weren't a whole lot of ARMs getting done. But you can see that since the fixed rate mortgages have skyrocketed since the beginning of this year, they've gone from 3.25 up to 5.5. That's the upper line on that chart on the right-hand side. Compare that to what the ARMs have done. They've barely budged at all. They've gone up a little bit, but not a lot. So increasingly, buyers are kind of faced with sticker shock. The home prices have gone up very dramatically recently, and the mortgage rates on fixed rate loans are up dramatically, and that means that the payment is up as much as 50% for some buyers. Very difficult for a first-time buyer to be able to accommodate that. So there's been a renewed interest in adjustable rate mortgages as a way to get around that. This would be especially attractive if you know that you're only going to be in this house for 3 years or 6 years, but a relatively short time period. If that's the case, you've locked in the loan rate for probably the duration of when you need to have it, and if you know that you're going to be, like your kid is in 7th grade, you want to stay in that house till they graduate from high school, and then you want to downsize and move to Florida. You're not going to need that house because you know when your kid's going to go to college. That might be like a situation that would apply to you, for example. So those of you who are older who are watching this video might remember, well, weren't there a lot of ARM loans back in like 2000 through 2006? And isn't that what has got us into all this trouble back before the last Great Recession? And that's partially true. So let's look at the facts behind that. So this chart will show you the market share of adjustable rate mortgages as a percentage of all of the mortgages in the market. And you can see that the gray part of this chart, the majority of it, is the fixed rate traditional mortgage. And the part that's sort of like this yellow tan sort of a color on the top are the ARMs. And you could see that in 2004, 2005, that ARMs were actually about half of the market. There was actually more adjustable rates getting done than fixed rates, if you could believe such a thing. And ever since the crash, you could see that the ARM share of the market's been like 10% or less. So a couple reasons for that. We were offering teaser rates in the early 2000s where your adjustable rate mortgage would be subsidized for the first couple of years. So if the market rate should have been, let's say, at that in those days, like 6%, they may have done it at 5% for a 2-year period, and then it would go to the real rate, which might have been closer to like 7 or 7.5. But they would qualify you on the 4% rate, and if you could afford that, just barely, they would give you the loan. And then 2 years later, you'd be shocked. If you wouldn't be shocked if you'd read the loan documents, but nobody does. When your rate adjusted to 7% and your mortgage payment went up by 50%, suddenly you couldn't afford the payment anymore, and surprisingly, you went into foreclosure. That's a lot of what caused that last gigantic recession that we had. There were several components, but that was one piece of it. So those sort of loans are now illegal. If you do an adjustable rate mortgage, there's usually going to be a cap on how much that rate can go up. So if your starting rate on your ARM today is 4%, it may only be able to go up to, say, 7%, and that's as high as it could ever go. The bank is going to underwrite you in a way to determine, like, if that worst case scenario happened, could you still afford to pay your mortgage and not be under financial stress? So the rules around banking changed dramatically, no surprise, after the Great Recession to make sure that this problem will not happen twice. So we've got a lot more adjustable rate mortgages now than we had before, but it's nothing to worry about as far as the overall market is concerned.